$500 a month in passive income. Sounds nice, right? That's $6,000 a year without lifting a finger. For some, that's pocket change. For others, it's a difference between struggling and breathing easy. Here's the twist. We're not talking lottery wins or crypto moonshots. We're talking about SCHD, a dividend ETF that's built on 100 proven US companies. It pays dividends 4 times a year. And yes, in 2025, it's still one of the most talked about income ETFs out there. So, can it really give you $500 a month? Or is that just another YouTube dream? Some people swear it's easy. Others say it's impossible. Today, I'm going to show you the math. And by the way, if you think $500 a month is enough to retire early, you might be living in a different century. But before we get started, a quick reminder that this is not financial advice. Chapter 1. How does SCHD work? SCHD is not just a random stock pick. It's a dividend-focused ETF. It holds about 100 US companies with a strong record of paying shareholders. We're talking names like Broadcom, PepsiCo, Cisco, Texas Instruments, and Home Depot. These companies make profits. They share a portion with investors. That's called a dividend. SCHD collects those dividends, then it passes them on to you. Simple. Now, important point, SCHD pays quarterly. That means 4 payouts a year, typically in March, June, September, and December, not monthly. So you'll get bigger chunks every few months, not a small check every 30 days. As of mid-2025, SCHD's dividend yield is around 3.7%. Historically, it's been in the 3% to 4% range. Chapter 2. The core math. How much to invest for $500 per month? Let's do the math. Your goal, $500 per month. That's $6,000 per year. If the yield is 3.7%, here's the formula. $6,000 divided by 0.037. That's about $162,162 invested. If we use a slightly lower yield of 3.5%, which SCHD has also averaged, the number jumps. Now you need about $171,428. So yes, the required amount changes with the yield. If the yield goes up, you need less. If it drops, you need more. And then there are taxes. In a taxable account, most SCHD dividends are qualified dividends. That means they're taxed at 0%, 15%, or 20%, depending on your income. If you're in the 15% bracket and want $500 after taxes, you actually need about $588 a month pre-tax. At 3.7% yield, that's closer to $190,000 invested. In a Roth IRA, it's different. Withdrawals can be tax-free if you follow the rules. That means $500 means $500 in your pocket. Bottom line, the math isn't guesswork. It's just numbers. And these numbers are why most people who want $500 a month from SCHD never actually calculate what it takes. Chapter 3. The time factor. Building to $162,000 plus. Now, here's where reality sets in. Most people don't have $160,000 sitting around, so you build it over time. That's where dollar cost averaging comes in. Invest a fixed amount regularly, no matter what the market's doing. It's steady. It's emotion-proof. Example, if you invest $500 every month into SCHD and it averages an 8% total return, 3.7% from dividends, the rest from growth, it would take about 15 years to reach $160,000. If you can do $1,000 a month, it's under 10 years. Start with $50,000 and add $500 a month, about 9 years. Even $100 a month matters. Sure, it won't hit $500 per month income in a decade, but it builds. And with dividend reinvestment, it accelerates. What about lump sum investing? Statistically, it grows faster. But if the market drops right after, can you handle the drop? If not, spreading your investments out over time can keep you sane. The key is start. The sooner you start, the sooner compounding works for you. Chapter 4. Dividend Growth. Why $500 can grow over time. Here's the part most people overlook. SCHD doesn't just pay a dividend, it grows the dividend. Over the last 10 years, the average growth rate has been about 11% per year. That's huge. Even if it slows to 6% or 7% in the future, your income will likely outpace inflation. Think about it. Start at $500 a month. In a few years, it could be $600 or $700 without you adding a single extra dollar. That's the power of yield on cost. The longer you hold, the bigger the payout compared to what you originally invested. It's not just income. It's income that grows while you sleep. Chapter 5. Realistic Considerations and Risks. Now, it's not all sunshine. SCHD has risks. First, market risk. It holds stocks. If the S&P 500 drops 20%, SCHD will likely drop too. It might drop less, but it won't escape. Second, dividend risk. Those payouts aren't guaranteed. If companies inside SCHD cut or suspend dividends, your income goes down. Third, sector concentration. SCHD doesn't hold thousands of companies. It's about 100 names, heavy in industrials, consumer staples, healthcare, and financials. Good for stability, but can lag in roaring bull markets. Fourth, interest rate sensitivity. When rates rise, dividend stocks can lose favor. That's what happened in 2022 and 2023. Then there's payout timing. Remember, it pays quarterly, not monthly. You'll need to plan cash flow and inflation. $500 today might feel nice. In 10 years, it might buy a lot less. That's why dividend growth matters. So yes, SCHD can get you there, but it's not a magic paycheck. You need to know the moving parts and accept the bumps along the way. Chapter 6. Portfolio Context. SCHD alone or mixed? Here's the question. Should you go all in on SCHD or mix it with other investments? SCHD is quality focused. It's not chasing the highest yield. That's why it's stable. Compared to others, VYM, Vanguard High Dividend Yield ETF, has similar yield, more sectors, slower growth. DGRO, iShares Dividend Growth ETF, lower yield now, but focuses on faster payout increases. Some investors blend them. Others add monthly payers like Realty Income, ticker O, to smooth cash flow. Allocation matters too. If you're younger, maybe 10% to 20% in SCHD, rest in growth ETFs. If you're retired, 40% to 60% might make sense for income stability. It's about balance. SCHD can be the backbone, but don't ignore diversification. One tool rarely builds the whole house. Chapter 7. Accumulation to Withdrawal Transition. When you're building, the goal is simple. Buy shares, reinvest every dividend. That's called DRIP, Dividend Reinvestment Plan. Each payout buys more shares. More shares mean more future payouts. It's a snowball effect. But at some point, you stop building and start using the income. That's the withdrawal phase. One way is dividend only. Live on what SCHD pays. Your principal stays intact. Another is the total return approach. Combine dividends with selling a small number of shares. The famous 4% rule fits here. With SCHD's 3.7% yield, most of that 4% is already covered by dividends. Taxes matter too. Roth IRA, income can be tax-free. Taxable account? Plan for capital gains and dividend taxes. This shift doesn't happen overnight. You plan it years ahead. That's how you make sure the income you've built lasts. Chapter 8. mindset, and patience. Now, this is the hardest part: patience. SCHD is not a get rich quick ETF, it's a get rich slow ETF. Market dips will come, prices will swing, but dividends usually keep flowing. When prices drop, you're buying more shares for the same money. That's good. The trick is not to panic, not to chase the next hot thing. The people who win with dividend investing are the ones who stick to the plan for years. One share, one dividend, one quarter at a time. So, what's the math? At a 3.7% yield, you need about $162,000 invested for $500 a month. Lower yield, you need more. Higher yield, less. The path is clear. Start early if you can. Invest consistently. Reinvest dividends when you're building. Withdraw smartly when you're ready. SCHD can be the foundation, but it's not the whole plan. Pair it with diversification, tax strategy, and patience. Do the math, follow the plan, and one day that $500 will be more than just income. It will be freedom.